Okay, here we go. Welcome, everybody. Thank you for joining and being with us today. We have a large number of people who have RSVP'd, and so I'm going to do, while the room populates, I'll do a little uh, Zoom housekeeping, and then, as usual, encourage you to ask questions as we go along here. As soon as they come to mind, put them in the chat box or the Q&A, and we'll get to as many as we can. We certainly appreciate you spending your time with us today at 2:15 p.m. Eastern Time. We're scheduled for an hour. We're delighted to have, as a result of Dave Siegel, he had introduced me to this group, and Jeff, and we've had a chance to get acquainted. I see David's on the call here. Thank you, David, again. It's all your fault. And so I've learned quite a bit, and you'll also be learning quite a bit from Jeff today. And as I said, we're going to encourage questions as we go along. As a matter of record, this is being recorded. If for whatever reason you missed something, have to go get a coffee, or you want to share it with somebody else, we'll post it on the Family Office Insights YouTube channel, and so you can, at your leisure, review it or share it with anybody that might benefit from knowing more about what's going on with Rightside Capital. And so thank you again for spending your time with us, and I'll be paying attention as we go along here. And Jeff and I have been able to have some really interesting conversations, and I think you're going to enjoy what he has to say and also learn quite a bit. So Jeff, it's all yours. Welcome.
Great, thanks. Arthur, thanks for hosting the webinar. Thanks everybody for joining. I'm Jeff Pomeranz, one of the managing directors of Rightside Capital Management here in San Francisco. And we are one of the most active pre-VC stage tech investors throughout North America. We launched our first fund in 2012, now have over 1,100 portfolio companies across our funds. We are bringing new investors into Fund 4, which we launched last year, and will have its final closing at the end of Q1 here. So let me just transition here to pulling up the deck and sharing the screen. Hold on one second, please.
Looks good. You're almost there. Perfect. You've got the next slide thing up.
Got it. Got it. Everyone see okay?
Yep. Perfect. Excellent.
Got it. So all of our funds, and what I'm going to talk to you all today, I'll go through, obviously I'll talk about our funds, our strategy, performance of our funds, but I'm going to first talk about the segment of the market that we take advantage of, this pre-VC stage that I'll talk about, how it evolved to be such a great opportunity. And I'll also talk about the tax incentives that are designed to incent early investors like ourselves that we can really build into our strategy. So all of our funds have the goals of being able to consistently and repeatably deliver 3 to 5x, so-called venture-like net returns to our investors, and this equates to roughly 20% annualized returns, IRR. We want to do this while protecting the downside, low volatility, and mitigate downside risk. And as I mentioned, the third goal here is optimizing for this tax efficiency by taking advantage of a couple really important tax breaks that I'll talk about later. The end result of that is we believe our funds will have close to a 0% federal tax liability over the life of the fund. And this holds in 45 of 50 states as well. They conform to the same federal rules. Now, so first is talking about the trends that have been going on a long time in the tech space that has led to the opportunity that we take advantage of. And what I'm talking about is the capital efficiency trend in the tech space. This is the cost to build software product. And what we're defining here is the cost to really for companies to get their first version of their product built and out to market, tested, and getting that first traction with customers and revenue. And this is the concept that what used to take tens of millions of dollars, over the years only took, from say the early 80s to 2010, the dollars decreased precipitously to the point where actually it would only required a couple or few $1,000,000 to do the same thing. In other words, what it used to take 4 engineers to do, only 1 needed to do, is necessary. Things like open source software, and just take something as simple as data storage, which used to require rooms full of servers and tons of equipment and people to manage it, is now a line item expense with Amazon Web Services or Google or some Google Drive. So while not a new trend, what has changed is these trends have hit certain inflection points in the past decade, which has been very disruptive to the tech funding market. And that's what we take advantage of. So the first real inflection point here was in 2010, as I mentioned, because the amount of capital here that now these companies were looking for to get their first product launched, only being a couple $1,000,000, that had actually fallen below what traditional venture firms were dealing with. They were typically writing larger checks as the venture asset class ballooned in size. And it gave birth to what we now refer to as the micro VC market, which is really just a way of defining sub $100 million venture funds. Since 2010, there's been many hundreds, actually leading to a few thousand new venture funds created, all addressing this seed stage and pre-seed stage market. Now, fast forward over since 2010, and the trend has just continued and has gotten even more extreme than we thought would be possible. So that instead of companies needing $1 million or $2 million, they're looking for just a few $100,000. And the difference here is that you can't keep shrinking this venture capital model down like you did with micro VC funds. At a certain point, it just doesn't make any sense for venture firms to bother dealing with those companies. So you now have, by 2016, we really looked at it like this is another inflection point, because now companies are bootstrapping themselves, or maybe a little bit of friends and family money, getting to the point where they can now launch a live product, get some early traction. And when they're first looking for outside capital from investors like us, they're only looking for a few $100,000. And that's just this is a market that simply did not exist 10 years ago. And that's what we really believe gave birth to what we call the pre-VC stage. And that's when it really took off. So the dynamics of this market are that today we have more companies than ever looking for very small tranches of capital. We're talking about companies looking for just $100,000, $200,000, $500,000. That's it. They are in this sweet spot of their life where they have a live product, maybe they have some early revenues, but they by no means have figured it all out yet. They might not really even know who their ideal customer is yet, or what their customer acquisition plan is yet. They're not ready to hire up, in other words, and spend lots of money. So they're not ready to raise a couple $1 million, but they do want and need these small tranches of capital. And so there's this huge demand from companies looking for small rounds of capital. But the problem is, again, these check sizes are just too small. So what has not happened in more recently is there's been no new body of investors, professional investors, move in to appeal towards this demand, because the check sizes are just too small. So that leads to this supply and demand imbalance, and the opportunity essentially that we take advantage of so that we can operate in a segment of the market with just virtually no professional competition. Now, that sort of defines the segment of the market. And then what we do is we solely invest into this segment of the market. We don't invest in later venture rounds, but where we would no longer have all of the supply and demand fundamentals in our favor. We're exploiting all these inefficiencies that exist at this pre-VC stage to capture the high returns that are there. And we all know that the earliest stage of tech investing has always had the highest returns, and for the very good reason that the risks are higher too. And then we're optimizing at a fund level to take advantage of the tax breaks. All of this again is directed at being able to now deliver, consistent 3 to 5x returns with substantially less risk than traditional venture capital. So how do we do this? Yep.
Can you make a comment about if they're not getting a check from you in this segment of the market, where are they getting?
Yeah, so good point, Arthur. So so the money that does float around in this is friends and family, individual angels. Angel groups tend to be also later, like early venture organizations. But the dollars that are there largely is just through bits and pieces, friends and family, and angels. That's really about it. So when we invest in companies, we're almost always the lead investor, and usually there's a small amount, a few $100,000 of some other individuals that follow us into that round. Usually they're, the typical case would be the company might have just started in an accelerator program, and they got maybe $50,000 or $100,000 from that accelerator. They have some other individuals dancing around them saying, hey, this looks really interesting. Let me know, keep me posted. Let me know if you get a lead. Let me know if you raise a round or something like that. And we come in, we move very quickly, we catalyze rounds. And it's a number of individuals might invest alongside us, writing $25,000, $50,000, $100,000 checks.
So there was actually one comment while you were making that, or a question, is are equity crowdfunding platforms filling in the void in this segment that is not being served by VCs in the traditional way?
Yeah. So the crowdfunding platforms, they're out there. Some years ago, the thought was that they would really fill that void, but the reality is that has not happened. There is some. I actually just spoke with a gentleman yesterday who worked at one of these crowdfunding platforms for a good number of years, and he put it pretty well. One of the problems is because of the friction and difficulty for companies to go through that process, and the kind of companies that actually go to those platforms, you're also not getting exactly the cream of the crop of companies seeking capital. But the reality is, the short answer to that question is no. It's not. From a dollar perspective, it's a drop in the bucket of how much money is actually being raised through these platforms. So it really hasn't made a dent on the demand that's there. The thought was that it would. It just hasn't taken hold from a demand side of it, from the investor side, as much as people thought it would. I think one of the reasons is it can become very noisy and difficult for people still to figure out which companies to invest in.
Perfect.
So let me touch now on how we addressed this opportunity and how we built a strategy to address the challenges that are there of needing to write very small checks and needing to do large numbers of them if you want to address the risk side of the equation, which is what we wanted to do. So we built a data-driven investment process. Think of it like a largely quantitative process that allows us to strictly use the objective data on a company rather than, our opinion and gut feel. This data falls into without going into too much detail here, it falls into categories like, the team of founders, where we know we can't predict if their idea they have or the product they have is going to be the next big thing, if it's going to beat other big competitors out there. But what we do know is we need a team of founders with the aggregate skill sets to build that product appropriately. They've got the technical skill sets, the domain expertise. Have they run startups before? And largely information that can be taken straight from LinkedIn profiles. We look at the business model a company has, how capital efficient it is, how much capital they need today, is it recurring or non-recurring? And we look at the traction a company has, how much revenue do they have, unit economics around that revenue and customer interaction, things like that. But what's important here is that these are all largely objective points of data that we can use to screen and select optimal profiles of companies, knowing that we then need to do large numbers of companies with those profiles. Now, one of the other things this does is it allows us to, number one, move very, very quickly. We can reduce the time it takes to diligence companies and select companies, therefore making larger numbers of investments without having a giant labor pool necessary to do so. And secondly, we also can create now a product to bring to the entrepreneurial community that previously really didn't exist. It's a really fast, transparent funding process. We're giving entrepreneurs yes or no answers within days. This saves entrepreneurs long, protracted, months-long fundraising efforts. That's really distracting to those founders. It's totally transparent. There's no longer just dragging things out saying, keep us posted or something like that. That's extremely appealing to founders, and because we're a lead into a space that doesn't really have professional lead investors, there's a huge appeal here to the founding community, especially repeat entrepreneurs that understand the fundraising process and how onerous it can be at this stage. And then what this also does, it allows us in combination to build ultra diversified portfolios. So we can now take what is individually a whole lot of individually high risk, high return bets, pool them together in a fund to now create a single fund with still a very high expected return, but we've protected the downside and knowingly sacrificing the massive home run win on the upside. That's the trade-off that we knowingly take. But in doing that, we can now pretty much lock in, we're going to get some type of return in the fat part of the return curve, which in this end of the market is still a very, very high return. So let me now address a little bit on the tax efficiency I mentioned. So there are two very important IRS rules that we can take advantage of, or other early investors like us as well, or angel investors and founders can all take advantage of these rules. They're not new. They've been around for a long time. They were revised in 2010 and made a lot simpler, which brought them, they used to be a lot more complicated, and so most people actually couldn't take advantage of them. But the first one is Rule 1202. And for any of you that want to reach out and get more, I'm only going to scrape the very surface of this, and there's a lot of nuances to how these rules work. The deck that I'm happy to share with you has a whole appendix. We put more information in there. We'd urge anybody that's an angel investor, direct investing investor, most important thing you can take away from this is know enough to bring it up to your accountant to make sure they know about it. But Rule 1202 is also referred to as the Qualifying Small Business Stock Rule, QSBS for short. And what it allows essentially is for qualifying events, it allows for up to the greater of $10 million of gains or 10x your capital basis to be free from federal taxes. And 45 of 50 states conform to the same rules. There's a number of tests that need to be done to see if that event qualifies, like an acquisition. The biggest are things like it needs to be a USC corporation. It can't be an LLC, for instance. You have to be a very early investor. And you also have to have owned that company as equity for at least 5 years. But then you get some very, very high, you get a huge portion of your gains tax-free. The second rule has to do, which is Rule 1244, has to do with how losses are treated. Obviously, plenty of investments don't work out. The startups fail, and we lose money on those companies. So there's Rule 1244, which is even more difficult to qualify. It allows for losses for qualifying 1244 qualifying losses to be taken as an ordinary loss, as opposed to just a capital loss, and therefore it's of greater benefit on your taxes. So again, in aggregate though, if you roll all of this together, most of our gains tend to be on companies that qualify. They tend to be on things that we've held for 5 years or longer. Therefore, we don't have taxes on most of the big gains, while all losses in some form are going to be deductible. And if they're 1244, they have even bigger deductions. The net of this is something close to a zero federal tax liability is what we anticipate for our funds. Our first fund actually has a net aggregate tax credit. So let me jump into just the performance really quickly. So I'm going to start with just talking about our first fund, because that's got the longest time associated with it. And then I'll talk about all of our funds as a whole. All of our funds have been performing according to our goals. They're all on track to reach them or exceed them. But let me just touch on Fund 1 here, which launched in 2012. It invested into 279 companies over a 3-year period of time, 2012, 13, and 14. And including our estimates of Q4 of 2020, we're now at a net multiple or TVPI of 159%, 1.59, and we've just 3.65, 365% up, and we've distributed 159% of investors paid in capital. So if you're an investor that has for every dollar invested, you've now received back $1.59, and there's still right around another $2, a little over $2 still left in value in the fund. And the fund is generally going up by a certain chunk every quarter still, because the big companies keep getting bigger. Now, the tax treatment here this is an example of what's happened with Fund 1 to date from a tax perspective. So for a $1 million investor in our first fund, and this data is only through Q3 because the tax stuff is a little more complicated and we haven't done those estimations for Q4 distributions yet. So through Q3, they've received $1.2 million, a little over $1.2 million of distributions, about 92% of which has been QSBS qualified gains. When you combine those gains being tax-free with how the losses pass through, in effect, for a $1 million LP in our first fund, they've actually received around 131,000 of losses that they've been able to take against other gains or ordinary income that they have. This is a chart.
So can I just,
yep.
Jeff, can you step back to that last slide for a second?
Yep.
So they invested $1 million and they've had distributions of $1.2 million.
Correct.
And they're still invested.
Correct.
And so they have a position in the fund that's continuing to do whatever it's going to do. And normally these distributions would be taxed at some rate, probably long-term or something like that. What is and I know you're not giving tax advice, but I'm just trying to crystallize this. What was the tax consequence of these $1.2 million distributions?
So in aggregate, in other words, the $1.2 million has come to investors over some years, right?
Yeah.
The total of all of that, though, is they've not only have they not had to pay tax on that $1.2 million because of how the losses work. In addition, we've pushed through on the K1 additional losses that they've been able to use against other gains and income that they have in other investments and so forth. And yes, to your point, good point to bring up. Investors are still invested in Fund One. It continues to, we're in a so-called harvesting phase of this fund. We're over eight years in now. It will go for another roughly 3 years or so before we wind this fund down. During that 3 years, we'll clearly end up with something like a 4 to 5x net multiple to everybody. And most of that 4 to 5x will not have had any tax associated with it. And again, to qualify, no federal tax. They're still, in my state of California, they're still going to tax me, and as well as 4 other states. But most states conform to the same rules. So we will essentially continue to harvest positions. We actually just did. We have distributions we've already sent out in Q1 here, and we'll continue to do that over the next couple of years as we sell positions, big acquisitions happen, and we ultimately wind down the fund a few years from now.
Makes sense. So some people are familiar with cost segregation and depreciation and real estate investing and that sort of thing. And it's a nice asset class because you can take advantage of a lot of that. But at some point, there's a day of reckoning.
Right.
And in this case, and you can't speak to what people might be doing with their other assets that might cause this to disqualify for them. But is there a day of reckoning here?
Yeah. So that's a great point you bring up, because no, there's no day of reckoning here. It's not deferred gains or anything like that, or there's no necessity to roll over the principal into something else like an exchange.
Mm-hmm.
It simply, these are just rules that were set up originally for job creation and incenting early angel investors to put high risk dollars into startups. It just happens that we can take advantage of all these same rules, and and you get the tax benefits of it, and that's it. There's no reckoning after that. Once you do that, it's over.
And you kindly mentioned that people should, if it makes sense, to let their accountant know and be aware of these, and they can implement it on their own. And
yes,
being in the fund, you figured all this out, and there's nothing about the fund. This is a question. There's nothing about the fund that does not allow you to pass these through the LP in the way that
correct.
Otherwise,
yeah. So it's actually quite the opposite. It all passes through on the K1, and again, to full disclosure and disclaimers and all this stuff, we're not acting as tax people. I'm just passing through some very high level information about the rules we take advantage of, and some of the most important attributes of these rules. But again, the most important thing is that you just bring them up to your tax people. What we found is that most people are largely unaware of these rules, which was a little shocking. But anyway, the way it works for a fund is from the IRS's perspective, the IRS treats each of our individual investors as if they are the beneficial owner of their pro rata shares of each of our positions. So actually, this $10 million of gains applies to each position for each LP of our fund. So when you realize that we're also making relatively small investments into hundreds of companies into our funds, virtually, we could have many tens of millions of dollars in gains on positions that all filters through to individual LPs as tax-free still. So it's a huge benefit. It all flows through on the K1. And part of the benefit here is we're taking care of all of that, of tracking the companies and giving it to everybody in a K1 with all the line items that the accountant needs to do the taxes. It's all done on the K1 for you.
So we covered this, but one last thing. This is super helpful. And it's probably a question you can't answer, but there are active and passive losses on the K1, or are they categorized in that way, or is that something the account?
No, it's not active and passive. It will show up as the stuff everyone's used to seeing, like a capital gain or a short-term gain, long-term gain, short-term losses, long-term loss, that kind of stuff. Plus, it'll also have this line item that says 1202 qualified gain. It's just a separate line item.
Yep.
And it just means the accountant just needs to know that that line item, there's no tax federally. Yep. That's it. And then there'll also be another line item that shows 1244 qualified loss. And it just is, that's a different treatment than a capital loss.
Yep.
But it's not active and passive.
Gotcha. Super helpful. Thanks for.
Great. Yeah, sure. Thanks for interrupting there. Okay, so I wanted to touch on, so that was fun. That was all Fund 1 because it's, later in its life. So it has the most history associated with it. And also just to mention with regard to performance on a relative basis here, all of our funds are handily outperforming our venture benchmark peers. So if you look at, Cambridge Associates, NVCA, for people that are familiar with this, they track every vintage year of venture capital returns and create what's effectively an index just as a tracker. It's a non-investable index. And all of our funds are in the top quartile, top 25% performers compared to our peers. They're all doing quite well. So this chart shows each of our first 3 funds plotting every quarter's net multiple since the launch of that fund. And it allows you to simply take, in green, you see Fund 3, and you can clearly see that it's ahead of our Funds 1 and 2 at the same point in time, this 3.5-year point in time. And because, again, without getting into all the details now, these investment fundamentals that I speak of about capital efficiency and how we take advantage of it and how they've become more and more extreme, that has essentially allowed us to invest in companies today that are further into their life cycles. They have more traction, if you will, more revenue than what we did in 2012 in Fund 1, but we're investing at the same average valuation as we did in 2012 because there's simply no real competition. That's pretty profound because it allows that clearly is one of the reasons why Fund 3 is doing better than our prior funds, and we expect it to outperform our prior funds. The other thing I like people to be able to see this for is it becomes easy to see that all of our funds are tracking in a similar manner. They're all doing the same things. They're invested in hundreds of companies in the portfolio. You don't get much volatility of returns, and that's part of the goal here. This is just, these are some of our biggest exits, and I won't dwell on them. It's always nice to talk about exits, but what you can note on here is by being invested, the combination of being invested so early at such low valuations and having a focus on capital efficient tech companies that very often don't need to raise huge rounds of capital. That means less dilution. It helps in the math of being able to create extremely high multiples of returns to us on exits that you wouldn't think of. I mean, most of these exits right here, these are not unicorn level exits, so to speak. A couple of them are. DigitalOcean and PillPack were billion, $2 billion exits. Most of them were not. So TradingView at the top, this was an exit far below $1 billion valuation, but we're getting 123x return on that exit because they're so extremely capital efficient. There's been hardly any dilution along the way. But anyway, not to dwell on those too much. To touch briefly on who we are. We have now been working together for over 10 years. The three of us as managing directors. Well, there's been no change in that ownership structure and management structure. We are all entrepreneurs and operators. We've all had multiple startups. I came from the financial services side of the world. I began at Smith Barney in wealth management. I started a brokerage firm. We were a technology research boutique and investment bank. And my two partners, David and Kevin, were both tech entrepreneurs with multiple startups through their careers in the Bay Area here. So let me close with some comments on the environment we're in today and what this means for our current fund that we're raising right now, which is Fund 4. So at a high level, to a lot of people, it's not intuitively so, but the current environment is really the best macro environment we could dream up for our strategy. And it's clearly the best environment we've had since we've started. Now, part of the reasons why is from a macro investment perspective, we now get to invest into a disrupted and recessionary environment. So we're investing at lower, investment valuations. We also, historically, recessions and coming out of a recession have historically always been best vintage years for all venture capital investing. And part of the reason is because it's not just that we're getting companies at lower valuations, but it's a better operating environment for early startups. Dollars go further. And disruption shakes up competition, creates opportunity. When you're small and nimble, it's easier to adapt and pivot and go after larger, more mature competition. So from a expected return standpoint, actually, we believe Fund 4, which has been investing through all of 2020 and will continue to invest over the next 2 to 3 years, it's the best macro environment we've had, and we expect it to actually outperform our earlier funds. So I'll pause there. For anybody that is interested, of course, feel free to reach out. I'm happy to share lots of additional material and more about what we do. Our final close on Fund 4 is targeted for the end of March. I'll exit out of the screen share mode here.
Great, thank you. That was great, Jeff. There's a few questions from Alan. For Fund 1, how many companies of the 379 were losses?
You're going to test me on my memory of each fund's numbers, but roughly 100 companies out of the 279 have exited as total losses. In other words, they've been, not just written off, but they've exited as losses. So roughly a third of the companies have been total losses to date.
Yep, that's
now to put that in perspective. That's far better than we originally anticipated. The nature of venture capital, all venture capital, is that it's a small portion of the winners represent the vast majority of the gains. It's the nature of all venture capital. We're no different. It's just by having, instead of a concentrated portfolio like traditional venture capital of 20 to 30 companies, and depending on one or two or three of them to be really massive wins, we depend on some dozens of companies to be wins. And we're focusing on a segment of the market where we want to be able to deliver 10x plus exits at very low acquisition valuations, sub $100 million valuations. That is I'm getting a little off topic, but that's really the bread and butter of what drives tech exits as a whole. Over 75% of all tech exits happen in this space year after year, most of which have never taken any venture capital.
You talked about some of the exits and highlighted them. Do you have an estimate of how many exits were in Fund One, and were they IPOs versus sale? And I know that that's getting into the weeds a little bit, and you answered some of it already, but
Yep. So to make a couple, and again, I'm happy this gets a little bit, I won't go into the weeds here, but again, I'm happy to share this data in our material to anyone who's interested. We're very transparent. We're happy to share position level detail on all of our funds and exits, everything. But to make a couple points here, we have lots of exits, lots of acquisitions. I believe Fund One has had roughly 55 or 60 exits out of that fund, most of which are relatively small acquisitions. But again, we can get 2 to 5x returns in these $10 million exit in acquihire virtually. We're not dependent upon IPOs at all. None of the exits have been IPOs to date. We do have several companies in Fund One that are moving towards that exit in the next few years, but we'll see how that plays out. We don't depend on that, however. The second source of liquidity and exits for us, in addition to acquisition, some of our biggest acquisition was Amazon buying one of our companies for $1 billion. So then you do get large acquisitions like that, which do become significant. But the second and very important source of liquidity is the secondary market, which has become, it's ballooned, it's grown massive in the past decade, and it's a great source of liquidity for all early people like us. Secondary market, think of it as just, other investment vehicles, late stage venture vehicles, private equity vehicles, buying out early angels and early VCs like us. So the point is, it's a great source of liquidity for us to be able to proactively sell positions as opposed to waiting for something to happen.
Yeah, very good point. What's the size of Fund 4 anticipated, and how far along are you?
So we're in the last few months of fundraising. We anticipate that the fund will be ultimately about 25 to 50 million in size, is where we'll end.
Great. What percentage of the companies that you reviewed do you invest in? I mean, that's
right. So very, very small, single digit percent. We have in a data-driven, a quantitative process like we operate, we've built a tech backbone ourselves of tools and systems to assist at every stage of our process. But as is relevant to this point you're making, the front end of that is critical to be able to screen through the vast majority of all of our incoming deal flow through whatever source of deal flow that might be. And philosophically speaking, we want to have as large a front end of the funnel as possible. So we see many thousands of companies every year. We've done some estimates that get to actually seeing over 10,000 companies touch the front end of our systems through various mechanisms. And we're investing in something like 150 companies a year. So very small percentage. The trick here, not trick, but the challenge in what you have to do is you have to be able to eliminate, more than 95% of that with either 0 man hours or a very small amount of time. When you're going to spend the time on the company, which you're ultimately going to have to do at some stage, we want to be on a company we're already prepared to write a check for. In other words, we've already screened it. We already have the data. It's minimal labor resources required to get to that point.
Very, very good point. I know what that's all about. I just haven't figured out how to do it as efficiently as you. What can you track the size? Fund 1, Fund 2, Fund 3, and now Fund 4, 25 million?
Sure. So Fund 1 was our first fund was 6.5 million. It was mostly friends and family individuals. Funds 2 and 3, they overlap a little bit. Combined, it's about $34 million between the two of them. They're roughly equal in size, but they overlapped. So that's about $34 million. And Fund 4, like I said, it'll be 25 to 50.
And do you care to share the fee structure?
Yes. The fee structure is very boilerplate. It's a management fee that averages 2% per year and of committed capital. It's pretty standard venture capital kind of terms. And then we have a 20% performance fee or carry. The only nuance here is we still have a preferred hurdle rate. So we have a 5% preferred hurdle rate, which means, and it's based on a cash distribution. So we do not take any carry fees until our investors are paid back all of their original investment capital, plus a 5% cumulative preferred rate of return.
Great.
And just on that note, Arthur, just on the terms and how the cash flow works, these are committed capital based funds. We call the capital from investors over a roughly 3-year period of time. As we invest the capital, we call it from the investors. For a new investor coming in today, their initial capital call would be 40% of their commitment, and the balance of the rest will be the remaining 60% would be roughly equally over the next 2 years. And we do it in predictable every 6-month capital calls.
Yeah. Cool. So when you talked about your filter on the front end, is that same system or some version of that built out in a way to monitor all the plethora of companies that you're invested in?
Yeah. So yes, we have invested heavily in creating a system. Think of it like a database, and in both monitoring, tracking, and capturing the data on all of these evolving tech companies. And we now have 1,100 plus companies, active companies. It's still over 850 active companies. And we are capturing business updates from them on a regular basis, starting off initially in the early days, it's usually monthly. It evolves to being quarterly kind of cadence. But we're capturing all of that data on companies over their lives. That data is extremely valuable at all levels of what we do. Obviously, there's a feedback loop of seeing so many companies in certain subsectors. We usually are often pointing out trends to some of our LPs, for instance, that are also investors. We're pointing out things that we're seeing before others because we see such volume of companies. It can be a feedback loop into a better selection process of criteria and characteristics of companies that we should be paying attention to, that will lead to better odds of success and so forth. It allows us to very quickly screen for certain companies that could be relevant for corporate venture arms or potential acquiring firms, things like that. So there's really a wealth of data in there that allows insights for us and allows us to utilize it in pretty creative ways.
Great. Super helpful. can you recap the check size and valuation that is your sweet spot?
Yeah. So by focusing at this stage of the market where there really aren't much in the way of any professional investors, it has one of the advantages is it keeps valuations low. So we're investing on average around a $2.5 million average valuation. Almost everything we do is in companies between a $1 to $3 million valuation. And we're investing anywhere from $20,000 to $200,000 into these companies. We do that really in a lot of creative ways. We have one of the ways we allocate dollars is we have built a lot of significant relationships within the accelerator community, which has become accelerators as a body, has become a huge part of the infrastructure in the startup world, leveraging off of the same capital efficiency trends we do. So we partner with a lot of them. We've got relationships with just many, many dozens of the top accelerators in the US. We allocate dollars consistently with them. We have ownership stakes in a couple of these accelerators, et cetera. So that allows us, reason why I'm bringing this up is because that allows us to deploy capital at some of the very small dollar sizes into larger numbers of companies. When I talk about $20,000, $30,000, $40,000 going into companies, it's usually through some of these accelerator partnerships we've been able to create. And then we have this other side of our systematic assembly line of $100,000 to $200,000 checks directly into companies as well.
And how are you typically making that investment? Is it a function of how the company is raising money in a safe or convertible note or something like that? Or is it something that you require a structure?
No, yeah, almost all investments, not just for us, but for the industry at this stage, is utilizing what's called a SAFE, Simple Agreement for Equity, which basically is like a convertible note, but has some advantages as to that actually apply to QSBS, among other things. So that was one of the reasons it was, and actually Y Combinator, we didn't invent the SAFE. It came out a handful of years ago as a evolution of a convertible note that's more favorable. But anyway, ultimately, that's the structure we utilize to invest initially. Ultimately, everything eventually converts into preferred equity at later rounds. And that's what we end up being owners of.
Great. Super helpful. You answered this question, but for the recap a little bit, are you a lead investor or just passive?
So we're a lead investor in almost all cases. That doesn't mean we're not passive after that in some cases. You would best to think of us though as we're not high touch taking board seats like you would think of as traditional venture, but we're not entirely passive either. We're like mentors to our companies during a important phase of their life and as needed. We don't force ourselves upon them. If they don't need our help, we're actually fine to be passive. We just, as long as they're sending us their updates, we're fine. And that allows us to track it appropriately and jump in if necessary, or they can reach out if necessary. So we tend to, the discipline is actually in trying to make sure we're deploying our resources and man hours into the companies at the important inflection points in their lives during this period of their life, especially, which is largely, think of it as like next funding rounds, where we're helping them make sure they're set up appropriately for it, getting it structured right, thinking about who to go to, what your options are, educating them, and so forth. We're also jumping in anytime there's a acquisition kind of situation comes up, or maybe it's a huge joint venture that they've never had to deal with. But we're not getting involved in the day-to-day, the month-to-month, the operational aspects or hiring and things like that.
Super helpful. We have a bunch of folks that asked for the ppm and so forth. So I'll send you the data.
Sure.
The I'm grateful for getting into the weeds like this, and I know that we covered a lot of topics, and it's one of the things that I'm really fascinated with is that you've created the mechanism that somebody doesn't have to create themselves to take advantage of the tax, and doing it in a way that you know once you do something and you do it again, you usually can get better at it, right? So doing something new, especially what's the old saying? The two things you don't want to see made: sausage and tax law, right? So
Yep.
the tax law is not the easiest thing in the world. Um, I'm going to take another question here, and then if we're butting up against the time here, but would love to have a sort of closing remarks from you.
Sure.
Regarding your safe, do you require standard or valuation caps or discounts, or is it company specific?
No, we have a standardized, what amounts to basically a take it or leave it a template for all of our offers. They all will have a cap and a discount in there. It's all very standardized. The cap is essentially what we're utilizing. That's our proxy for when we peg a valuation. We're using the cap as a proxy there.
Yeah, totally makes sense. What's the investor check size?
Right. So yeah. So the stated minimum commitment to our fund is $500,000, and again, that's a committed capital call basis. We're pretty flexible with that, depending on the nature of the investor. I'll also mention that we do have for those people that also are angels or like to do direct investing as well. We're very open to relationships with firms like that. A subset of our LPs, our investors, are direct investors as well, and we're essentially a farm system, among other things, of feeding great opportunities and they're co-investors with us, follow-on investors with us, et cetera. So we're open to that dialogue as well.
Yeah, great. Jeff, you did a great job. Really, really appreciate it. And
Thank you.
you want to just wrap things up real quick and then closing comment, and then we'll make sure you get in touch with everybody.
Yeah. So, well, thanks again, Arthur, and for everybody that's joining. I'll obviously follow up with some form of an email to people. You're welcome to reach out. Anybody that wants to learn more about what we're doing, see more information, and consider our Fund 4. Obviously, happy to launch into more dialogue. At a high level, again, our funds are all designed as a way for people to get exposure to a segment of the market that's usually very difficult to get exposure to without taking inordinate levels of risk. We've done it in a way that our funds can give people exposure to many hundreds of companies spread out over a multi-year period of time, thus smoothing out the risk curve, capture a consistently high return, sacrifice the massive upside, protect the downside, take and reap the rewards of the tax benefits there. So thanks again. I appreciate it.
You're very welcome. And thank you everybody for being here. Just a couple footnotes. The intent of this call was to get investors into Fund 4. And so if you're going to bring a deal, even though the deal flow is important to Jeff, you can bring a deal, but bring a check too. So Jeff's too polite to say that, so I'll say it. Not to thwart any deal flow, of course. And I super appreciate everybody in the Family Office Insights community joining in today. As I often say, thank you for sharing the only thing you can't make more of, and that's your time with us. And it was really a good job, Jeff. Thank you very much. And thank you.
Thank you. Thank you all.
Take care. Bye-bye.